good afternoon, and welcome to another kind of a unique edition of 4 Minutes with FourThought. I'm Scott Pinkerton, managing member of FourThought, and with me,
Jake McFarland, research analyst at FourThought.
Now, last week, Jake, we just put out a 40-minute webinar on our economic review.
Right.
And the day that we did that was the day that the U.S. women won the Olympic gold.
They stuck the landing.
Stuck the landing. And you would think, from watching the Olympics, that was just yesterday. If you look at the markets in the last 3 days, we've had a ton of volatility.
Sure.
Kind of walk us through what you see is happening.
Well, it all starts if you just watch the market. We had about a 10% decline almost in the S&P 500 and about a 14% decline in the NASDAQ. So the growth stocks pulled back more than the broad market. And there's a couple of things that have led to that. First would be looking at the labor markets. Saw some weakened data come in on the unemployment side, jobless claims, quit rates, all sort of came in weaker. But at the same time, we had a Fed meeting where Chairman Powell sort of put his foot off the brakes a little bit in terms of expecting a cut, and that's completely goes against what the market's predicting right now.
Yeah, it's interesting on the jobless claims. Many statistics are showing, the unemployment's ticked up a little bit. At the beginning of the year, the Fed predicted that the end of the year unemployment rate would be about 4, and it's now at 4.3%.
Right.
But what's interesting is while that's going on, workforce participation has gone up, and the number of people working has gone up. So our workforce has increased faster than new jobs. So it's creating this kind of a brackish water. The other thing that's happening is volatility has picked up. So we had a 1,000-point decline, 900-point decline. Today's been all over the place. Japan was down 12%, then up 10%. And Japan's really been an interesting player here. What's going on there?
Well, if you look at where interest rates have been in Japan, they've been near zero. And so what that's allowed for is what's called a carry trade. And that's investors were going in Japan and borrowing money.
At 0% interest.
At 0%. And they were exchanging that into US dollars or British pounds and investing in the risk-free assets, earning in the US around 5% now currently.
It's a risk-free way to make 5%.
Well,
so you levered it up.
But it also depends on exchange rates when you move back into the Japan dollars to pay off your loan.
So Japan last week unexpectedly raised their interest rates. The United States is going to be lowering their interest rates, weakening the dollar, strengthening the yen. Yikes, that doesn't look good for the carry trade. Massive flows of money.
And so what we've seen is a lot of folks, traders, trying to close out those carry trades. Right. So selling of U.S. assets, of European assets, translating back into the yen to close out those loans.
If you looked at our video from last week, one of the things that we're worried about is a decoupling of the bond market from what the Federal Reserve is going to say. So two things. One, now the prediction is that the Fed's going to lower 50 basis points. So there's some room for the Fed to lower. The second thing that I think is just amazing is, and this is good, is that the bond market reacted just as you would have hoped. So bond yields came down. That's an extremely positive sign. It means that there isn't a decoupling between what the Fed's trying to do and what the market sees. So our bottom line is, so far, this looks like a normal hiccup correction in a market that got a little ahead of itself. So thank you again. Always don't hesitate to call. And remember, great planning requires forethought.